coming today. If you do not know me, my name is Jane Joseph. I'm the Director of Communications at Innovation Works, and this is Cafe RW. Cafe RW is our programming designed to help entrepreneurs with skills that they can use to improve their business. And so there's a lot of new faces in this room. If you don't know about Innovation Works, just know that we are one of the most active seed stage investors in the country, but we are focused on the 9-county southwestern region of Pennsylvania. And that means we're dedicated to the success of this region. We support tech entrepreneurs across hardware, software, life sciences, and now thanks to Build Back Better, robotics. And you might have heard of our accelerators, Alpha Lab Here, and Alpha Lab Health, and now the Robotics Factory. So I just wanted to thank our sponsors. They're the reason why we can have programming like this, and they're the reason why everything is possible for us. Ferris is the first one. This gorgeous room is actually a part of Nova Place, if you did not know. Sister Sid & Co, who can help you with your accounting and tax needs, and Buchanan, who can help you with any legal advice. So as we get started today, we have a wonderful panel. We always tell founders to find the right investor for them, but I don't know how often we actually can go into what that means. So thankfully, we have Ven and Sree, who I personally asked many questions about this topic with, and we have Lori Dunn from Optimus Technologies, who has actually gone through a very successful raise in the spring. So without further ado, welcome to our panel.
Hey everyone, is this on? I'm kind of loud anyway. Hey everyone, I'm Lori Dunn, COO of Optimus Technologies. We are decarbonizing heavy-duty trucking. Really fun. We do a quick bolt-on upgrade and allow 100% biodiesel to run through a standard engine. So technically, at the moment, we are the only one decarbonizing at scale today. It's really fun, and we're on this like really interesting kind of rocket ship. I joined the team about a year ago and just moved to Steel City in January. So if you have any tips, please hit me up. I'm really trying to get integrated here and kind of understand the scene. So thank you for IW for having me, because I feel like I'm gonna get a lot of friends here. So one of the things that did happen this spring that was just mentioned is we successfully closed a 17.8 million Series A. IW was part of that. I cried a lot, so you're awesome. It's hard. It's hard to find the right ones. It's hard to sit in all of these conversations with different investors and pouring your life out, right? For many of you who are founders in the room, you deeply believe in this work, whether you invented it or dreamed it up or trying to find money to continue that ideation and build it. It's really hard to sit with someone and they've also had 40 people talk to them that day and they have to quickly assess yes or no for them. It's deeply uncomfortable. It's like finding a job, it's like dating, it's like any of those other deeply uncomfortable human things we go through, but it's all associated with this dream that you have and this vision that you have for a better world. So I'm really excited to chat with our two panelists today and have them introduce themselves and dive in a little bit to some of the questions we've already talked through, and then open it up to the crew for the last 15 or 20 minutes. So first up, we have Ben.
First of all, thank you for having me here, and thank you all for coming out this evening. My name is Ven Raju. I'm President and CEO of Innovation Works. For those of you that don't know, Innovation Works, as noted, is one of the most active early stage investors in the country, the most active here in the region. The way we think about investing in the early continuum is to help businesses at that critical area that we call the Valley of Death. So some of you may be familiar with Stephen Markham's concept of Valley of Death, where in the first 18 to 24 months, due to lack of access to networks, lack of access to capital, lack of access to support faculties that are critical for businesses, most businesses fail. And so Innovation Works is really designed to help companies at that early formative stage through our national ranked accelerator programs in hardware, software, life sciences, and now robotics. Our accelerator programs offer capital as well as support faculties for businesses in the most formative stages. Beyond that, we have a seed fund where typically we invest in 40 to 75 companies per annum. These are companies that have either evidence product market fit or are on the cusp of evidencing product market fit. There, we're generally the first institutional investor. Beyond that, we have a growth fund for companies that have evidence product market fit, are looking to scale in some capacity, and we provide very early growth capital to support their growth. That, in a nutshell, is innovation. Thank you again. Thank you for having me.
Hello, everyone. My name is Sree. I am part of BlueTree Venture Capital, which is the follow-on fund from BlueTree Allied Angels. We've been in the Pittsburgh ecosystem for the past 20 years, up until recently as a very early stage investor, seed or even pre-seed investor. Now we've moved up to Series A. We're typically investing in companies that are revenue generating, software-enabled tech companies, and we're looking for companies that are targeting getting to an exit in 3 to 5 years. So that's who we are. We've been around for a while. I think many of the people in the ecosystem know who we are.
Awesome. Thanks, everyone. So let's get right down to it. Let's assume we are a pre-seed kind of area. We're going to one of these events, right? Where you're meeting, there's potential to meet 40, 50 different investors. There's a lot for us to sort through and try to identify how do we quickly and effectively identify a fit for us before we schedule meetings. And if we find out when we get in the meeting that it's not a fit for us, how do we effectively end things without potentially burning a bridge? Because y'all are so connected with one another, like in the same way that you're sorting through us, we're also trying to find the right fit ourselves. So how do we effectively come prepared and behave appropriately so we can continue on in the ecosystem?
So first and foremost, know what you're asking for and what you're looking for. So you often know how much money you're asking for. It is a raise of a certain size or a certain range, but know what else you're asking for. So the way I like to talk to a lot of our companies is, this is the most expensive capital you're going to get. You're going to give up equity for capital. You can't get the equity back until you sell the company. You're stuck with us. So understand what you're expecting your investors to bring to the table to help you out. That being said, understand what the investor's role is, and then I'll get to the question. I do love doing sidetrack here a little bit. Their role is not really to bring you customers. If you can't get customers, that's not on your investors. That's understanding your product market fit. They're to help you understand how to go to market, how to grow the company, how to scale the company. What are the kind of roadblocks you're going to face down the road that they can help you prepare for, because they've seen this 8 or 10 or 12 times beforehand and can tell you, okay, you're doing great, but at scale, this type of computer software is going to fail, or you're going to have multiple suppliers because in case one fails, you want backups or things like that. That's where they can really help. So know what you're going to ask for and then be very honest about it. If you are in a conversation and you're in a big room and you're trying to figure out who's going to be the right point of view, the object is not to try to get every person in the room to invest in you. The object is trying to get the right few people in the room to take the next steps with you as a partner in the process. And so going on to once you're in that conversation, let's assume that you got a conversation with an investor and you realize relatively quickly it's the wrong investor. You're a seed, pre-seed company, and I'm a Series A investor. There's a mismatch there. Rather than trying to exit the conversation, figure out what you can get out of it. So theoretically, I might be an investor in the next round. I also probably know a lot of the players in this ecosystem that, and I know them more than just, okay, A, B, and C fund invest this money. I can tell you, these guys are good at this, and these guys are good at that, and these guys are good at this. So be honest. Look, we are a pre-seed seed company. We obviously know that we're a little bit early for you. You know, here's what we are. Here's what we're looking for in our investor group, our syndicate. Who would you recommend this to? Are you willing to make some warm introductions? Here's the problem we're trying to solve. Do you know anyone else who's dealt with similar based problems? So use it to your advantage. Don't think like you have to end it just because they're not the right investor. Use them as a way to get warm introductions to narrow down your funnel as quickly as possible. You don't want to talk to 100 investors, and I don't want to talk to 100 companies. If I can find the right ones quickly, I'd rather spend more time with them than trying to sort through it all and sift through the sand to find the diamonds in the rough.
Tell me what it's like to not talk to 100 investors. I'd be interested.
My generally first objective in these type of forums is to do no harm. Yeah. Is that on? Yeah. As I said, my first objective in these type of forums is to do no harm. So I'll do my best, but let me back up a little bit. Not all businesses are venture profile businesses. If you are looking for equity funding, there are different avenues for equity funding. And I think first and foremost, you have to do a self-assessment of your business. What is the type of business you're in? Is it a venture profile business? What are your near-term capital needs? When I say near-term, in the next 12 to 18 months, what are your near-term capital needs? What are your long-term capital needs? And that's very hard to assess when you're in the early stages. Your long-term capital needs, the best way to benchmark your long-term capital needs is to look at analogous companies, companies that are in similar types of businesses and have gone to raise capital at different stages of the business life cycle. What have they raised? How have they raised it? That's a good template for you to follow in terms of how you think about raising capital for your business. Now, in terms of avenues to raise equity capital, there are a number of avenues. There's accelerator programs, which typically write checks on the smaller side, but provide a whole host of support faculties to help you with your business. There are friends and family, who is essentially more of a donation pool. Their expectations on returns and expectations on kind of what they want from the business may be very little. They are really investing in you because they like you, they care about you, whatever the personal reason may be, or the personal affinity may be. Then there's angel investors. These are generally high net worth folks that are looking to make an investment. Generally, they're investing in you as a person. They believe in your idea. They see some viability to your idea, and they're willing to write, checks sub 500K to support your business. Then there are institutional venture investors. Institutional venture investors are a completely different breed. They are looking for returns in excess of 150 through to 300% or more in a span of 4 to 5 years. So per annum basis, they're looking for 30-35% return on capital in terms of their overall portfolio. And what that generally means is they have some outsized returns, they have some 1x, 2x returns, and they have a number of companies that go to zero. But they are really targeting companies that have the propensity to have a 10x return, 10x, 50x, 100x return. And so, that comes with a lot of privileges in terms of the scale of capital, but comes with a lot of obligations as well. And I'm sure questions later on will lend itself to answering that.
Sure will. So both investors and accelerators a lot of times tell us that they're offering mentorship. Some kind of thing, like we mentioned, they're not going to bring us customers, but some kind of mentorship or other incentive when you join. Oh, we're not just financial, we offer this. How do we identify if that's what we need at this time from this investor? Like if I'm a seed and if someone's typically a Series B, but for some reason they like me, they want in, is that the right time for me to bring them in, or is the advice and the mentorship not aligned with what I need?
First of all, if the investor's investment thesis is not aligned with where you are as a business or what you do as a business, they're not going to invest. So that, first and foremost, there has to be a fit in terms of your business profile, where you are in terms of the business life cycle, and what the investment thesis for the investor or investment firm is. And so after that alignment comes in place, then you have, what I'd say first order considerations are in terms of what are additional value adds that this investor can bring to you beyond capital. And generally, when you're running a business, you know what you need. You need customers. You need help with product. You may need help accessing additional investors. You generally know what you need. And the best way to vet investor counterparties is to talk to firms that they've invested in. Have they invested in industry that you're in? Have they seen exits in the industry that you're in? Have they supported these companies in a way that they're promoting, support these companies, whether that's, access to these networks or support with product or whatever way they may support companies. The best way to ascertain that information is to go out and talk to the companies that they've invested in, talk to the investor, get a sense of, what they're investing in and what kind of support they've provided. But it's really, you want to make sure that you are, that first order consideration includes other needs other than capital needs.
Yeah, and I'd say one of the big things is think about what you need. So you need what your business needs to grow, but understand what your investors' expectations are. So for example, if you're coming to us to invest in you, we want you as any of the equity investors we're talking about, we want you to sell your company. Eventually, we are going to be very upset if you tell us, oh, this company's throwing off a lot of capital, it's paying me a great salary, I don't want to sell it. Because we give you money and we don't get dividends, we don't get interest, we get nothing until the exit. So the caveat to that is you probably know how to build your business, you know how to get your clients, you know what your pricing models are. What you probably haven't done yet is actually exited a company. And you haven't done it multiple times, which hopefully your investors, especially your later stage investors, have done. So what they're adding to you is not how to run your business. Hopefully you've got that done. They can help you understand a few of the nuances, and they're often great sounding boards, but think of them as helping pull you out of the weeds. So you are working day to day, working on your business. Their job is to pull you up and say, look, you're going through this, but that's the end result. What do we need to get there as well? For example, you might be, one of our companies is a supply chain company. What do they need? It depends on their exit plan. If their exit is to go into these facility managements, they need to be able to prove that they can have a very high average contract value for those facilities. If, on the other hand, they want to sell to a data analytics company, they need to prove that they have the right amount of data at different levels. The ACV doesn't matter anymore. Which way do they go changes how they build their business. That's what your investors can help you think about. Think strategically about different questions. How do you get to exit? How do you get to the next round? Who can they help you with? All of those. How do you grow from a local to a national company? How do you grow from a national to a global? How do you build the supply chains? Those are questions they can help you with, more so than running your business. So understand what it is you're really asking of them, and then be very clear that that's what you want them for.
And there are domain-specific investors that really understand the domain, that really understand the business, and can really help you kind of navigate the business life cycle. And so you want to make sure you know what you're looking for, and you want to make sure that the investor has the requisite capabilities to do that.
And going to one other thing Lori said, the wrong level investor, it might sound like a great name. I'm gonna pick like Sequoia. Let's say Sequoia says, I'm interested in you, I want to invest, and you're a seed company. Understand, they're trying to take their companies global to an IPO. And that's what they're gonna be pushing you towards. But if you haven't actually proven product market fit, if you haven't gotten the foundation right for them, they're gonna assume that's already there. That's typically what the C's and the A's help you with. And so they're gonna assume that, and so they're gonna be pushing you to grow when you're not ready. And that's their expertise, they're very good at it. But if you're not ready for it, building up to that when you don't have the foundation set can structure you for problems down the road.
Sree, can we tap in a little bit deeper? When we were prepping, the big talk was about like the relationships you also build with the investor, and like what that looks like for us on our side when we're bleeding and need help, and like how willing, I guess, our investors should be to help us.
So okay, I'm gonna preface this why, for those of you who know BlueTree, we are an active investment fund. We are active with our company. So I'm approaching this question from that perspective, but when you're having trouble, you should be able to pick up the phone and call your investors and ask them, have you seen this problem before? Some of my companies I'm on the phone with every day. Some of my companies I don't hear from except when they're ready for their quarterly updates. And that's not bad. Some of them know what they're doing or they have other investors. So we have a pet oxygen company. I talk to them if they want to talk about business strategy, but if they need to talk about how do we get into vets or how do you get to the distributors who sell to the vets, that's not me. There's other investors who are there for them. But at any given time, your investors should be willing and able to pick up the phone, and you should be willing and able to call them. And if you're not comfortable calling them, and if you're meeting with an investor and you're talking to them and you're like, they can write a great check, but I'm not willing to go out and have coffee with them or talk to them, they're probably not the right investor for you.
You know, a perfect example is the SVB crisis. I remember that weekend vividly. A number of our portfolio companies had their primary checking accounts, capital accounts at SVB, and all their money was frozen that Thursday night, that Friday morning. And before the Fed stepped in on Sunday, we got a number of calls from our portfolio companies trying to figure out how they make payroll next Tuesday, how they could potentially raise a bridge to make payroll to support kind of immediate needs for the business. And you know, that's a kind of an exogenous crisis that prompts you to kind of reach out to your investors. And there's a lot of other types of issues that occur in a business, but that's one where it was. We had that weekend, just me alone, I fielded at least 35, 40 calls from our portfolio companies in terms of how they navigate the next couple of days. And there were a number of times where we had to get on calls with other investors to see if we could potentially come in and bridge these companies to make payroll and to continue operations so that they don't shut down. Luckily, we didn't have to effectuate any of that, given that the Fed came in. But those are the types of crises where you want to be able to call your investor. And on that note, the relationship you have with your investor, and it's really a singular relationship. It's not with the investment firm, it's with the investor, whether that is an associate, a junior partner, or a managing director at any of these firms. You want to ensure you have a good working dynamic, working relationship with that individual, because that's the person you are going to lean on in times of crisis, and that's the person you're going to lean on to access all the help that we talked about earlier, all the value add services we talked about earlier. It's their networks, it's their access to customers, it's their access to additional capital resources, and so you want to ensure that dynamic is good, and you're going to be able to work with them, and that's part of the selection process.
And I'll double down on that, especially when you're talking about those investors who are going to be sitting on your board, either as board members or board observers. They're the ones that you have to have a personal relationship before you even start the round, or before at least you sign up for a term sheet. You should know who that investor is putting in as their board member, and you should be comfortable that they're the people that you would want to be calling when you can't access your money at the bank, or when COVID hits, or when something bad happens. This is someone that I feel comfortable with. They're on my board, I'm updating them quarterly, but when something bad happens, I know they'll pick up the phone and answer it, because they have a vested interest in me, and I have a vested interest in them, and we have a working relationship.
Yeah, I'll add one more layer. We were very lucky that SVB crisis wasn't something, we weren't in that bank at the time. But once all the cards were falling on that Thursday, Friday morning, I had a text from one of our investors that I have a personal relationship with that said, hey, is this something we need to worry about? Can I add you to one of the calls we're having with all of our teams? I didn't realize that was what I needed in that moment, but while everything was kind of falling around me, I was really grateful that I had focused deeply during the round of building that relationship with this person. And now, anything that happens, it's just, there's a different level of, it's almost like a friendship, don't cross that line, but like, it's almost like we're at that level. Career advice, other things, even as we're building Optimus together, Lori has help as well. And having that relationship was something I didn't expect out of a Series A, but I'm really grateful I found. So if you think you can find that in someone, if you trust someone, like, please believe your gut, because it's worked very well for me, I will say. So we just talked about positives. What are the risks or any of the strings with accepting money from an investor? Like, is there a risk that you needed to save someone? Maybe you were at a networking event and you saved someone from a risk that they didn't see. Something that maybe we're just a little blind right now, but some of the pitfalls we could hit.
The biggest risk from our perspective is misalignment. You are focused on building a company that's going to grow to an exit, and they're focused on building you to an IPO. So they want revenue growth, they want you to become cash flow, they want you to become a profitable business. You want to build up for a strategic advisor, and suddenly you're being pulled in two different directions. Even worse, two of your investors, especially two board members, are on opposite sides of the table on things, because now you have your opinion and they both have their different opinions, and everyone's pulling everyone in different directions. Catherine, my partner and former boss, she often says that her first book is going to be How Boards Kill Companies. And it's because of that misalignment. When the board isn't aligned with each other and when they're not aligned with the founders, that's where we see some of the biggest risks.
I would agree. Investor alignment is key, and that starts with the founder, and that starts with the founder. That's what it starts with, the founder understanding what their business profile is, what their capital needs are, what their long-term capital needs are. It's hard to predict exit profile, but you can predict your capital needs. And to the point of cash flow break even or profitability, what type of capital is it going to take to run your business? And based on that, you want to ensure that you get the right set of investors that are not only able to write that initial check, but also able to write follow-on checks or bring follow-on investors to the table. And to the point of having the right board and board composition to support you and guide you, if everyone's on the same page in terms of capital needs, in terms of growth needs, in terms of support needs for the business, you will be far ahead in terms of finding the right board members and making sure there's that alignment and fit.
The other thing I'll add on to what Ben said was the needs are important, but also understand, and this is a question you can ask your investors, is what is their time horizon? So if you're accepting money from a fund and they're in year 6, understand that they're going to want an exit in 4 years, by year 10, because they're typically going to be a 10-year closed fund. That is very different than accepting money from a fund at year 1, where you have 9 years to grow it. Because you're going to start, after you accept the money, within 2 years, they're going to start asking you, okay, are you ready to sign an LOI? Are you ready to sell the company? Because that process, again, takes more time. So suddenly the pressures are going to change, and especially if you have one fund that's early and one fund that's late, they're not aligned as well. So, and it's an easy question. All fund managers know the length of their fund and they're willing to answer it. It's nothing private, there's nothing bad about it, but it allows you to help align your strategy with their strategy.
Let's get it fun. Let's have a fun one. Let's talk about pitching. When we're pitching, how do we present ourselves well? Is there a reason that we need to present like higher up than we are? If it's my first time I'm coming in a seed, but I want to seem like I know what I'm doing. Is there a reason for me to, or resources even, to use that I need to present a little differently? Or am I just coming in as raw and honest as possible with a solid pitch and just the reality of this is what I'm doing? I'm a first time founder. I believe in this.
It depends on who you're pitching to, right? And if you're pitching to institutional investors, they are looking for a certain return profile, a certain exit profile. You want to ensure that your pitch caters to their return expectations and return profile. And, that's the part I was talking about earlier. Make sure you do a good self-assessment of your business and where you want to take the business before you start trying to identify investors and go to the pitch. But essentially, you want to cater to the investor class. And you want to cater to the expectations of that investor class. Institutional investors have a certain return profile. You want to ensure that, the growth projections, the forecasts that you're putting forward are in line with their expectations. Apart from that, it's this, kind of the traditional, what is the problem? How are you tackling that problem? What is the market size? How are you going to penetrate that market? And how are you going to effectuate sales to evidence that kind of growth profile that the venture investor is looking for? Now, if you're pitching angel investors or other compositions of investors, it's slightly different. And those that have domain expertise in your realm may be more focused in terms of the technical nuances and the product nuances than those investors that are more financial investors. So you want to cater to the investors long and short.
You can do that by researching them, know who you're pitching to and what they care about. In general, though, they're going to care about a few things. First and foremost, they're going to want to know about the problem you are aiming at solving. What is the problem? Why do you care about it? What is going to be, so there are going to be hard days and hard nights ahead of you. What's going to make you work through and stick to that problem? How are you personally connected to it? What's your solution? And how are you approaching the problem differently than others? So if you're solving the same problem in the same way everyone else is, and you just have a technological leap over, understand that most investors are going to say, well, the next technological will leap over you as well. But if you're approaching a problem in the market, philosophically different, you're attacking it from a different angle that allows you advantages that others don't, unfair competitive advantage you can call it. That is something that we all are looking for, because that's how we say that this is going to actually grow into something either big for those that are IPO investors or attractive for those that are acquisition investors. Those are the big things. Going to the question, should you oversell? And the answer there is, my personal belief is no. And the reason is twofold. One is, more than likely you're going to get caught because investors are pretty good at asking a lot of questions and understanding. Two, if you're not caught, then you have to live up to it. And guess what? They're going to be on your board. They're going to see it afterwards. And they're going to be digging in. And they're with you for the next, 18 months until you do your next fundraise. And then the first thing that the next round is going to ask your current investors is, how was it? And you want that answer to be a good answer. And so that doesn't mean go in unprepared. That doesn't mean don't prepare. You should practice your pitch and practice it and get the cadence down and make it very real, but don't feel like you have to live up to whatever if you're pitching to a Series B investor, you don't have to be ready to scale globally. Because if you're not, you're going to get yourself into trouble. And if they don't invest, that's all right. It's not the end of the world. It's worse if they do invest, and then you end up in an even worse situation, because then you hurt your own reputation for this and in the future.
Well said. The milestones you set for that prospective investor, if that investor is an investor that turns to an investor that's on your cap table, those are milestones that you will have to evidence. And so just be mindful of that, be realistic in terms of what expectations, what forecasts you set forth, because you're going to have to live by them. And more likely than not, it's not going to be the last check you ask out of your investor, and you're going to have to go back to them. And so you want to be very careful to kind of balance both, hey, this is a high growth business, but also set realistic expectations of what you can actually execute on.
On that side, especially on the finances side, I know like Ben, and we've seen it so many times, people project very fast growth. I'm going to be at 1 million this year, 5 million next year, 50 million the year after that, and then 500. And we see those numbers, like those numbers are not crazy for what we see. My point on the financials is understand what those financials tell of the story that you're telling. So if you're telling me that you're accelerating revenue growth, what you're telling me is you're growing a great business that will live forever. You're growing to an IPO because that's not an M&A, because soon if you actually execute the plan you set out, you're gonna price yourself right out of all your acquirers. So suddenly, we're no longer, if I'm an acquisition type investor, you're not a good one because you're gonna grow too fast. That's what your story is telling me, that's what you're aiming at. So understand that we're often not looking at the numbers themselves, we're often looking at what those numbers mean in terms of what is it in your head about how your story is, about what your company is.
5 more minutes for the Q&A, look at that. So when should you bootstrap instead of taking investment? Is it when I'm mad?
So my point would be, understand why you're taking the investment. So bootstrap is great and should be done, especially for working capital, keeping the business moving forward. Investment capital is for really growing it above and beyond, because for every dollar you take in, if they're looking for a 10x return, that means you have to take their dollar and multiply it by 50 because you're only giving up 20% of your company for that growth. You have to be very efficient with the money you're taking in from investors. To the extent you can bootstrap, especially working capital, go for it. And also understand to Ben's earlier point, there's a lot of different sources of income. So we often talk about fundraising as we need 2 million this round. But what you really mean is what you say is you need 2 million in funding. What you really mean is you need 2 million in capital. That capital can come from sales, it can come from a loan, it can come from revenue financing, it can come from equity financing, it can come from mezzanine debt. There's other options. In some companies, only 1 to 2% of all startups are venture capital backed startups. And the reason is there's a lot of different ways to grow great companies that don't need venture money to get there. So if you're going to take venture money, understand one, you're setting yourself up to sell your company. You can't hold on to it forever. 2, you're going to be pushed into grow and grow and grow because that's how we get our returns.
Again, not all businesses are venture profile businesses. Not all equity capital is equal. You want to be mindful of the capital that you take. I always have the view, if you don't need venture money, don't take it. It is very expensive money. You have to be very capital efficient with that money, and it comes with a lot of strings and expectations. And so you just want to go in knowing that. And there are other financing options as Sree noted, and certainly you want to fully explore those avenues and ensure that they're a fit or not a fit before you consider venture.
The other way I look at it is, if you're thinking about taking venture money, think what help you need and expect your investors to provide assistance, and by the way, also some capital, not the other way around. We often think about investors as investing capital, and they might also provide some assistance. That's kind of the flip because it's so expensive in terms of the capital you're giving up. You're giving up control of your company, you're giving up board seats, you're giving up equity in your company, you're giving up, you're now putting people on top of you that are going to be watching you and watching every dollar you spend. But if you're new to this and you need someone that's got financial background that can help you on kind of the CFO, understanding how to do your capital structures, or in my background is intellectual property, helping you with your IP, or getting you ready for an exit, or understanding how supply chains are going to affect your growth. And by the way, they're also bringing capital to the game. Great.
That bought me the time I needed to open the question. Does anyone have a burning question? They just have to ask Ben and Sree. I have more.
Hi, my name is Max. Thanks for your time. So obviously, a lot of institutional investors have their investment thesis on a website. They have portfolio companies that you can look through. At the earlier stages, right, for your sort of angels level investor, is there a good way outside of LinkedIn or maybe Twitter to find out sort of like what drives angel investors and sort of what their investment thesis might be?
It's through networks. What businesses have they invested in the past? Try to find a way to contact or connect with those businesses. get an understanding of, what the investment has done for them and how the investor has conducted himself post-investment. The best diligence is firsthand diligence, and particularly with individual investors, you want to make sure that you vet them before you bring them on to your cap table, and certainly before you bring them on to your board.
The other, yeah, I'll get that. The other answer I'd say to that is ask if you're in an accelerator or incubator, ask the people running the accelerator or incubator. If you have other investors, ask your other investors. If you have friends, family, classmates in the ecosystem, ask them. You're going to get a more realistic answer, and it'll be more valuable. It'll help you narrow down your funnel relatively quickly.
What if you ask and nobody knows that? Is there another way to back channel that reference?
One is, so you can go through the normal channels of LinkedIn, Facebook, all the others. Two, then I especially on the early stage, I'd be wondering about them as an investor. Are they relatively new to the region? Like, why is it that no one knows? If you've talked to like in Pittsburgh, if you've talked to IW, if you've talked to Ascender, if you've talked to RK Mellon, and they haven't heard of this investor before, and they don't have any portfolio companies that you can talk to, then you kind of need to just either you take a flyer and you walk away, or you have to meet with them and you have to do your diligence on them as much as they're doing their diligence on you.
Yeah, so first I'm interested in social benefit venture capital, but I think this question applies to other specialty venture capitals, like ones that are interested in environment or interested in minority or women CEOs, for example. The question is really, how do those sort of special provisions of the fund impact the way that it's placed forward? So I was assuming it would just be kind of table stakes. If you're in that category, you get the possibility of getting considered, and everything else is pretty much the same. Is that the way it plays out, or is it?
You mean in terms of thesis-specific funds, whether it's a diversity thesis or whether it's a social impact thesis? So they have different return expectations and different profile of businesses that they're looking for. That's a very good question. So, there are institutional investors that play in the social impact space or the diversity-centric thesis space that may have different return expectations than a traditional financial venture investor. And you want to be mindful of that. You want to know that going in, and you want to ensure that your business fits the profile that they're investing in. But certainly there are those type of investors.
The only thing I'd say to that is ask. So there are certain funds, especially those that are backed by different government entities or foundations, that have different profiles. And there are others that have very financial based profiles, and it's just one of a set of criteria. The easiest way to figure that out is just ask them. It's too hard to narrow them down because everyone uses the same language on their websites and on everything else.
Another bucket there is strategics. Strategics have a different profile that they're looking at. They are looking to not only optimize financial return, but also optimize what they term as strategic synergy. How does your business help their parent business, whether that's in terms of adoption of the product or service that you're developing, or other synergies that may be extracted as a function of your business and investing in your business. So you want to be mindful of those type of investors as well.
And adding to that, like what stage it's in, we have some non-strategic investors, and then to close the round, strategics came in and swept the board because we got to that stage. So our seed, our pre-seed, it didn't look like that, and now we're at a scale that strategic is the bulk of that 17.8.
Strategic investors tend to be less valuation sensitive. They tend to be little more forgiving in terms of entrepreneur friendly terms. There's trade-offs to having strategics on your cap table, but again, you want to fully understand who you're dealing with, before taking their.
I'll add to that. So strategics are great, especially to close out around. Just be mindful of two or three things. First is they likely don't want to be on your board because of ethical rules and liability issues. They're typically not going to be board members if they can avoid it. Secondarily, you don't want them on your board because if you have a strategic on your board, you're more than likely going to lose all of their competitors as clients because their competitors don't want your board member to see all of their contracts and if they were to make an offer, what their offer would look like and all of that. So be careful about that. That also goes to picking your board. Be careful about who you pick. So everything else we said stands true, but also ask them how many boards they're on. If someone's on 8 or 10 boards already, the likelihood that they can give you the time you need, especially for an early stage company, is going to be difficult given how many other commitments they have versus someone who's on 2 or 3 boards. So people tend to want to be on boards. Don't grab board members who just want to be on your board. Grab board members who want to help you.
Yeah, my name is Jeff Whitmore. I'm working with a biotech company, so biotech company from the lens of biotech. And I guess the question is, if the company has a product that, beyond maybe what I call an MVP in like the, software space, where it's, the technology is patented, it works, number of folks working on it, and it's really the go-to-market arm that needs help with scaling. How do you guys think about, is there a specific revenue target or number of customers, or something that we should keep in mind before going out and seeking, a decent sized Series A? And I recognize there's probably a lot of moving parts to that, but if you kind of think like, okay, the product is solid, it's patented, it works. We need to work on scaling revenue. Obviously, we're going to give away a lot more of the company if we don't have a lot of revenue at the outset. So is there kind of a sweet spot or even a range that you guys would think about in terms of number of customers, overall, revenues incoming, that would make us more competitive competitive terms going out this?
So independent of industry, I would say it's 2 things. It's how big is your revenue and how fast is it growing. Are going to give you, what you're looking for is what gives you leverage in setting the valuation. Also understanding that once you're within a reasonable valuation, you as the founder don't want it to be too high and you don't want it to be too low as well. Us as investors don't want it to be too high or too low as well for different reasons. So too high of a valuation puts a lot of pressure on the next round. You have to execute a lot to justify that valuation and then justify a much higher valuation for the next round. Putting it too low sets an expectation for the next round. Oh, look at how low it was last time. We are not going to give you 10x. So then we're going to give independent of how it's doing. So it's hard to say explicit numbers. You're going to have to look at your individual industries, but there are 2 factors. There's how big is your revenue? That's what everyone talks about. But how fast is it growing? Are you gaining clients at a pace that makes your revenue growth justify a higher valuation, or make a lower valuation actually a negative for everyone involved? Or are things kind of flatlining and you need that, and the revenue itself may justify high valuation, but the growth, adds questions to your investors' minds?
I would say it's very industry specific. Biotech, for instance, it's very capital intensive. You need a lot of money at the outset. The amount of capital at the early stages is order of magnitudes higher than, say, enterprise B2B SaaS. And so you want to look at comparable firms that are doing something analogous and look at the stages at which they raise capital and how they've raised capital and benchmark yourself against that. And so to think of it in terms of generic revenue terms or generic client terms or an X number of clients or X dollars in revenues, you want to kind of change the paradigm of thinking in terms of how you think about what you're raising at any given stage of your development.
Yeah, following up on what Ben said, revenue is great, growth of revenue is great. also look at margins, also look at cost of goods, look at where you can bring down cost of goods by ordering at scale if you can order larger amounts. There's a lot of different ways that those numbers, and those are the conversations you have with one or two investors, whoever's going to eventually become your lead investor, to justify where you should be.
Can I just ask a quick follow-up on that? So like, I guess that's really helpful. I think maybe quick follow-up to me, that would be, how much value do investors generally put on intellectual property on the solution? If there's product market fit there, is there a mix in terms of revenue versus, IP or value in the product? Maybe what's more salient?
No, that's a good question. Venture investors don't think of IP as an asset. They think of IP as a barrier to entry. So they think of it as a means of protection, not an asset that they're looking to recover costs or recover investment from. And so when they're doing your valuation, they are basing it on your current financial position, your forecasted financial position, and market comparables. They are not assigning a specific value to your IP assets. And certainly Sree can speak better to IP than I can.
That's the correct answer in general. So if you are a founder and you have some IP, especially patents, but maybe some other IP, lacking anything else, they're not going to put value on it unless you build value in it. And the way in which you can do that is to say it creates a barrier to entry that'll allow us to be acquired for X amount, or it provides us a way that no one else can do a trade secret, that no one else can do this and they can't reverse engineer it. The reason that that's important, and the reason I was kind of specific about the language is, let's assume you have a patent on something, especially because I'm jumping into patents because most people focus on that when they talk about IP. You're more than likely not going to stop anyone else from doing what you do because of your patent. And the reason being is almost no companies that we know of, at least in our portfolio, have $3.5 to $5 million to fight a patent lawsuit, nor do they have 3 to 5 years to be stuck in litigation. It's not worth it. On the other hand, patents are great PR tools. They are great for structuring for your acquirer who does have the money and the time to fight it. And they want to know that they have something valuable. So you do it and do it right, but understand the reasoning behind it.
First of all, I want to thank both of you, given us such great information and good questioning on your part. So thanks for also being honest to say that don't ask or go win the lottery. That is a good point. Having said that, he said the biotech question, and I'm following up on it. Is there any way we can pitch to the investor to say, okay, it's going to take a while to get the returns, but it's still worth it because you will get it in the end? Is there any way we can convince them?
That's baked into biotech, right? That is the essence of biotech. So, investors that are versed in that domain are very versed in the investment horizons for those type of businesses, and either they're comfortable with those investment horizons or they're not. And if they're playing in that domain, they are comfortable with those investment horizons. So I would not focus your pitch on, the return horizons are long here. They understand the return horizons. You just have to articulate why it's outsized returns in that given horizon, which they're already comfortable with if they're investing in biotech. Does that make sense?
Yes and no, but we'll talk later.
The other side of
Thank
that
you. Yes.
is if you are a biotech company, especially when you're looking at your early money, understand that it's a long horizon. That money is very important, but make sure that you're getting it from people who can add value. So more than likely your early investors don't have enough money to take care of you all the way to the end. So do they have connections to other funds that have the money? Can they introduce you to Series C or Series A or Series B investors who can then take it to the finish line? Because I'll go with therapeutics because that's what I'm more familiar with. It is, you're looking at rounds as you get, even before you get your first pill into anyone's hand, you're looking at $100 million rounds to get to phase 3 trials. It's a lot of money with no revenue at that point. And you need to find investors early on when you're in your IND or your pre-IND stage who can say, look, if you get to the IND, we can get you to this investor who can help build a syndicate around getting you through the phase A trials. And they can get you to the investor for phase B or B1 or B2 on the phase 3. Like, it's a lot of money. The horizons are very long. The investors understand that, but make sure you pick the right investors that can help you get there, not by themselves, but that they have the network to kind of bring the rest of the syndicates around.
Pharma, therapeutics, biotech, these are very long investment horizons. Generally, only domain-specific investors play in that space, and they understand the investment horizons that they're dealing with. They understand generally the outcomes are binary. And so, your case has to be, how do you distinguish from that peer set? Not really, you don't really need to educate them on kind of the investment thesis and the horizon, because that presumably that's something they're already comfortable with.
Thank you.
We'll do one more question. too.
One more, go for it.
I'm curious if you see any trends about what companies typically get wrong in their pitch decks, or what's typically missing from the pitch decks, and also how should pitch decks differ for different occasions, such as pitching to investors is very different than submitting pitch online and somebody evaluating it without a pitch. So how should it be different? What's missing?
Our big pet peeve is buzzwords. Blockchain, AI, LLM, generative. Anytime I see that, I almost immediately throw it out. Unless you can justify it. If you're talking about blockchain, you're not telling me how you're going to generate your own distributive network that's actually going to provide some value. Or if you're talking about AI and you're saying AI and you're not saying machine learning, expert systems, deep learning, you're just saying AI, or you're saying LLM and you're not talking about how you're going to have your own model, which is very expensive to build. You're basically telling me you're just throwing out a buzzword, and even if you know how to use that tool correctly, there's nothing proprietary that you can really create in that tool. Now, the fact is, there's a lot of AI around here, but you need to sell it on the problem. So if you think about it, one of the largest AI companies in the world right now is Apple. Not once in any of their marketing material did they talk about AI. They talk about what problems they solve and how they solve those problems. AI is built in as a tool to solve those problems, but that's not what they sell you on.
The only acronyms we like to hear are ARR, MRR.
Can you both tell
That's a
me,
joke.
can each of you give me 2 takeaways that you want everyone in the room to have after this hour?
I think the first takeaway is be as selective about your investors as your investors are about you. Build your syndicate so that they actually add value, so that they get you to where all of you want to go together.
Do your diligence. Similar to how the investment firm does their diligence on your company, what you're doing, you as an individual, you should be doing the same level of diligence on the investor. And again, not to harp on this, not all businesses are venture profile business. Understand your business, understand your near-term capital needs, understand your long-term capital needs, and then make the assessment in terms of the type of investor class you want to go target.
I think my second one would be truthful, be true about who you are, be true about where your company is, and be true about what you do. And if the investor doesn't buy into it, great, walk away because they aren't the right investor for you. Don't feel like you have to land every single investor. Find the right ones, find the ones that really believe in you, your problem, your solution, and get them on your cap table.
Make sure you come to IW first.
Yes, that part.
All right, so real quick, we will have some time for networking. So can my founders in the room just raise their hands so our panelists know where our founders are today? Oh my goodness, hello, there's a lot of you. This is incredible. Thank you for coming today. Thank you for our panel for joining us and sharing your expertise. Amelia Earhart for being in the front. Thank you, Energizer, for a battery that lasts for a microphone, if anyone is curious how that was helpful. And yes, we were here, we're wrapping up, but please stay